The Sydney property market. It's Australia's most expensive capital city property market, and despite interest rates being the highest they've been at for over a decade, property prices have continued to increase, defying the expectations of so many. But we're now starting to see some dubious headlines. Mortgage arrears are starting to increase. Property sellers are dropping their prices in certain areas. And there are now a number of suburbs where property prices are lower now than they were 3 months ago. So does this mean that finally Sydney property prices are about to drop? Well, it's time to separate the facts from fiction. Let's dive in. Hello, it's Nero here, and if you're new to my channel, hit that subscribe button because I talk about all things related to the Australian property market and the economy. The Sydney property market has continued to defy what so many people expect. Yes, property prices did drop from May 2022 when interest rates started to increase, and they dropped all the way until February 2023. During that period of time, Sydney was the market that dropped the most. But from February onwards, Sydney property prices turned around. They started to increase. In fact, Sydney was the first market to increase and led the property price rebound for many months. However, for some time now, Sydney house price growth has been overtaken by many of our smaller capital cities such as Brisbane, Adelaide and Perth, plus many regional markets. Now, if we look at the Sydney market specifically, what we can see is that on an average level, property price growth is slowing. If we look at the latest data from CoreLogic, we can see that Sydney house prices grew 5.6% over the last 12 months, but in the last 3 months, they've only grown 1.1%. So if we annualize that, which means we multiply it by 4, we only get to an annual growth rate of 4.4%. But then if we look at the last month, we can see that property price growth has slowed all the way down to 0.3%. If we annualize that, so we multiply that by 12, we only get to 3.6%. So you can see that when we annualize the quarterly growth right now, or we annualize the monthly growth right now, and then project that going forwards, we can see that growth rates are likely to be slower in the next 12 months than they were in the previous 12 months. However, I'm looking at Sydney as a whole. Sydney is not just one market. When we break it down, we actually start to see a different story. Here we have data again from CoreLogic looking at how well different suburbs in Sydney have performed. This little code here says that the dark blue are areas that have risen by 6% or more in just the last 3 months. Now, if you were to annualize that, that would be then 24% growth over 12 months. And then we have the different codes, and once we get to light pink or even this orange color, what we're looking at are suburbs that have dropped in value in the last 3 months. You can see that a lot of the suburbs closer in to the city, they're actually falling in value, but some of these areas like Fairfield West are performing extremely strongly. But that doesn't mean that all areas on the outer fringes of Sydney are doing well. For example, up here near Kurrajong Heights, property prices have fallen in the last 3 months. So what that shows you is that even though on an average basis, property price growth in Sydney is slowing, certain areas are still doing very well, but certain areas are actually falling. So does that mean then that property prices in Sydney are going to crash? Well, for that to happen, you've got to ask yourself, why? What would make them crash? Is it going to be the fixed rate mortgage cliff where lots of people can't afford their mortgages? Unlikely. The surprising figure that shows why the mortgage cliff didn't happen. Australians are putting any extra cash into offset and redraw accounts, new figures reveal, hosing down fears that homeowners unable to afford their mortgages would be forced to sell their homes. The extraordinary war chest of other savings built up during lockdowns had been drawn down at a steady rate from about $220 billion when it peaked in the second half of 2022 to about $80 billion by March this year, CBA research shows. So yes, it's been a reduction, but $80 billion in savings is a huge amount for a country of our size. But here's what's interesting. The circa $80 billion of savings put away in offset and redraw accounts has only been rising since. So in other words, mortgage holders have been putting away more money into savings, offset accounts, getting ahead on their mortgage since March of this year, even though rates are at record highs. And this next chart really illustrates it. We're looking at cumulative pandemic savings relative to the 2017 to 2019 average. Now, mind you, back then property prices were lower than they are right now. Most people's debt levels were lower than they are right now, and interest rates were lower than they are right now. And yet, look at how much we're saving on average as a country compared to where we were in 2017 to 2019. The latest data from ABS, RBA, CBA, and Macrobond shows that plenty of Australians are still ahead on their mortgages and they have savings. That's why CBA head of Australian economics Gareth Aird tipped that savings would only grow as rates remained high. Money into offset and redraw is still going up. There are lots of customers who are still meeting the minimum repayments, he said. Households will do whatever it takes to keep the home. And that's the key thing. That's the Australian way. We will do whatever it takes to keep our home. So if distressed sales are not going to increase, why would property prices in Sydney crash? Are we suddenly building a whole host of new properties across Sydney that will make us go into oversupply? No. As you can see from the latest ABS data, monthly approvals are actually falling. We're now 2.1% below where we were last month. But what you can see when you look at this chart is that dwelling approvals, so that means the number of houses being built and the number of units being built, has been falling since about 2021. We're actually building fewer properties now than we were a few years ago, even though our population right now is bigger. So it's not as if we're going to have a huge oversupply across Sydney. However, there are certain pockets we need to avoid. We know that the federal government has a target of building 1.2 million homes over 5 years, and although they're going to fall short of that, the New South Wales Labor government is trying to do its best to build lots and lots of new properties. Again, even though it's going to fall below target, there will be certain areas where they build almost too many properties, and you need to avoid those higher density areas because those certain areas could be at risk of oversupply. So again, it comes down to the macro level data versus understanding the micro level data. But overall, is the Sydney property market going into oversupply? That's just not going to happen. Sydney still attracts the majority of overseas migration, so that still brings enough people into Sydney, and that means as long as demand is higher than supply, property prices are not going to crash in Sydney. But then what about unemployment? We know that unemployment is rising right now, but we still know it's well below long-term levels. So although certain segments of our population will struggle, overall unemployment levels won't have an impact on property prices either. So what that means is that there are really no reasons for the Sydney property market to crash. But does that necessarily mean, though, that it's the best place for you to buy an investment property in? I know many people who live in Sydney, have lived here for many, many years, say that Sydney is the only place to buy a property. And if you can't buy a house, then you buy a unit or you buy a smaller property, but you only buy in Sydney. And they're really looking at things through broken lenses. The Sydney property market is our most expensive market. Yes, prices are rising on average, but price growth across multiple other areas around the country has been so much stronger, and I expect they will continue to be so much stronger purely because Sydney's property price affordability is so bad. And what that means is that the excess of buyers over sellers is far less than in other places around the country. In other places, there are more buyers than sellers. The gap between demand and supply is much higher because affordability is so much better. And that's why if you are someone thinking of buying an investment property, don't worry about a property price crash. It's not going to happen in Sydney. However, that doesn't mean that I think Sydney will be the place to invest for maximum capital growth going forwards. There'll be other areas that are far more affordable, a lot cheaper, and the rental returns will be so much better. Sydney rental returns are the worst in the country right now. So that means if you want to buy a property that's more affordable, got better capital growth prospects, better rental returns, you are then better off looking outside of Sydney. And if you want help on how to do that, check out the link in the description below to get totally for free the audio version and digital version of my book. Otherwise, I'll see you next time.